The Dutch team. Who had the best header goal in all of World Cup history?
RVP.
Okay, well, you usually moderate these things, but I have, Ilya, are you on?
Yes, Mark, hi.
All right, over to you. Your panel is mostly some of
Uh, Great, it's a pleasure to get started here. Why don't everyone please introduce themselves? I've done the introduction on the prior panel, but really quickly, I'm dialing in from Monaco. Was a family office CIO for 9 years, allocating predominantly into private credit funds, while also participating in co-investments with those funds with the objective of achieving above market returns while also being senior. With that, why don't we start with Nazar? Just because I had the pleasure of being Nazar's LP and also co-investor in a couple of his deals.
Okay. Thanks so much, Ilya. Well, it's a pleasure to be here. I'll do a quick introduction, but just want to thank our hosts for organizing a great group. We enjoy being in front of this audience because, as Ilya mentioned, our firm has a lot of family offices and other kind of non-traditional investors. We focus on infrastructure investing. We do a lot of work with private, kind of lower to middle market companies. We're about 45 people across the US and have a couple of different alternative strategies, but all focused on partnering with private kind of entrepreneur-led businesses across industrial infrastructure, energy infrastructure, and all of the above. So pleasure to be here.
Great. Rich, you're next.
Sure. Hey, Rich Wyatt, Rosemar Management. We have 3 verticals. We're a private credit focused investor. We have municipal credit, education-based real estate, primarily charter schools, and I lead up our sourcing and origination efforts in sustainable energy, sustainable infrastructure.
Thank you, Eddie Vanderpart. I run a single-family office, Polish-American, and have an early-stage climate tech platform. And I'll be sort of basically taking the hat from a family office perspective, how it is to invest and how basically to sort of prosecute private debt in the infrastructure space.
My name's John Cox. I've founded Cox Capital about 5 years ago. It's a secondaries fund which is focused on purchasing non-traded and illiquid products in the secondary market. So it's a traditional secondary strategy, but focused on non-traded BDCs, non-traded REITs, interval funds, high capital feeder funds, that sort of thing. So we access credit indirectly through those wrappers.
What I love about your approach, sorry, is that it's not just secondary, it's like the venture world. It's in this world that we're talking about here today.
Right, exactly.
Damon Uzon, InfraDX Capital. We focus in on water, wastewater, and wastewater-related energy recovery. We do development, build, and operate platform. And so basically think about it as wastewater treatment plants, maybe as small as 5 to 10 million, maybe as big as a couple $100 million as they keep on going up with inflation, but that's our focus area.
Great. Just so that we can all have a better grasp of what you do, would each one of you kindly describe your typical deal? What does it look like?
Okay, we can like rotate a little bit, so I don't. Ilya, maybe somebody in the middle of the panel.
Wants to go last?
Yeah.
I can start. So we got introduced to this asset class a couple of years ago, and we started to write our first tickets into transition tech. So a couple of our portfolio companies are very much involved in making sort of power to X, renewable natural gas to low carbon gasoline, for example. In order to do that, you need large infrastructure from hundreds of millions to billions. And in order to do that, you need typically some type of bridge financing. And that bridge financing is one of the things that, for example, a couple of people at this table offer. And so to name the sort of the terms, it's sort of a let's say 18 months to 3 years duration, mid to high teen return on your debt, plus typically some type of warrant coverage upside linked to the performance of the asset, that could eventually yield you significantly over 20% IRRs. And obviously it depends all on the stages of the technology, stage of completion, what type of collateral, how securitized and collateralized the asset is, etc. But those deals are attractive both from by the way, an operator perspective, because you don't dilute that much, as well as from a sort of a holder of the paper. Particularly if you've done your analysis with regards to the underlying complexities of the asset.
I can go next. So our,
Actually, I think you played to that way. It's just, I think you should go last, John.
all right, I'll go last.
Right? No, because I don't. Why don't you go, because you represent what he's talking about.
Sure. Just a couple quick examples, and one we're actively working on right now, it would be for data center. So large data center, $9 billion. They're focused on water in their site. Literally forgetting about water. No access to water, no plans, and they got to figure it out. So give us a call, help us. What are they get basically a development plan together, and by the way, we can provide some of the bridge financing to get it to the point where it's construction ready. Kind of on the other end of the spectrum, small example, Salesforce down in San Francisco. About a $5 million full water reuse system. It's mandated in the city of San Francisco. You're seeing more and more cities. And so it's kind of same thing whereby we can, with our partners, kind of design, build, operate, and then we would basically take it off balance sheet. And same thing, that would require some bridge financing to get it to that point where it's stabilized.
Make it sound so simple.
It's so not.
Sure. Yeah.
So we focus in on primarily solar and battery storage opportunities in the middle market in the US only. So on the solar side of things, think of a 1 megawatt project is about 5 acres of land. So we're not doing large utility scale, which is, let's say, 100 megawatts and up. We're doing mostly projects that are about 5 megawatts and less, all the way to rooftop. We focus on our deal sizes are usually portfolio oriented. So our sponsors that we're dealing with on the credit side, we're dealing with multiple projects that they're putting out. So they're cross collateralized. We're cross collateralized on a per sponsor basis. Oh, you know what? Yeah, I think that's okay for now. Or maybe, yeah, maybe another one later. Okay, thanks, Mark. Our deal sizes are typically. Okay, sure.
Okay.
Trace, sure.
Sounds like some good companies. You know, some of the things that you just mentioned could fit us as well, but think of it a privately owned company, like entrepreneur led. It might be owned by that entrepreneur or owned by a family or kind of friends and family, if you will. It's been around for 5 or 10 years. It's operating. It is in the business of investing and owning hard assets. So it could be a large industrial kind of facility, could be like we've had small, mid-sized ports, it could be water facility, what have you, but it's kind of owned and operated by these entrepreneurs. You know, they're facing a little bit of a crossroads. They really like being independent and really like the business and see a very strong growth path. Maybe they're at 10, 20, 30 million of EBITDA now. They see a path to 100, but because they're in the hard asset business, they need somebody to provide that capital. They've kind of bootstrapped their way to this, cash flow their way through this, but they now need 50, 100 or 150 million to get to the next level. And the expansion multiple is very, very attractive because they control the whole company and they really value independence. So then we come in, we say, hey, we'll be your capital partner going forward. You can retain full control of the company. You're excellent at operations. We're very good at commercial and other structuring because we're industry people. So we'll not only give you capital, but we'll help you get to that 50 or $100 million EBITDA level. So we've done 43 deals like that. So they all across different hard asset spectrums, but that's the profile.
Great.
Okay.
Let's talk about, oh, sorry.
I forgot that Rich had the slide. maybe just give a quick.
Perhaps the other slide before I could talk about just what we do. Yeah, so, power development is similar to real estate development from the standpoint of you're talking about land going to operations at some point in time and construction in the middle. In our sector, there's been really post 2022 banking crisis, SVB going out, they were a big lender in our space. There's a dearth of private or of banking credit, certainly in the middle market. We focus on deal sizes that are anywhere from about $5 to $50 million. So the MUFGs of the world are lending construction in term 50 and above. We fall way below that. We tend to do shorter duration credits, six months to 3 years, anything from bridge loans on Tesla megapacks, those are large stationary source batteries, to solar panels, and then we do unitranche construction through operations. Let's see what else. The other thing we're noticing is we're a tweener, so we play between really high, really expensive growth capital and venture capital for developers, and cheaper cost of debt further into operations. So we fall right in between that area.
I like the elephant in the room. Like, well, wind is like thrown out the window. Solar's still good.
Yeah. So all the energy that was added to the grid last year, 90% was renewables. And we have over 275,000 people working in solar alone in the country. But with the new administration, we're dealing with tariffs. I think certainly that's creating disruption, but the Biden administration doubled tariffs on Chinese panels. Going from 25-ish to 50, Trump's now going to potentially 60. That's manageable, but I think that is a elephant, but the bigger one is what's going to happen with the congressional, with budget. So tax credits are an important part of how projects get financed in renewables. We don't invest in tax credit deals, but it's an important part. And we believe that the Inflation Reduction Act is going to be impacted. That was the 2022 act that extended out investment tax credits and all sorts of other energy incentives. So we see opportunity with that because a lot of the developers we're dealing with need bridging solutions during this period of uncertainty over the next 6 to 9 months. And the other thing to note is even without these investment tax credit incentives, solar is still cheaper to build than natural gas. The other thing is because we're dealing with such huge power demand increases with AI, I'm seeing things. Yeah, I'm just seeing things in the energy sector that I haven't seen in 20 plus years. It's really a generational increase in demand. And so if we go down the path of just saying, well, the new administration just wants natural gas or nuclear, the problem with that is there's literally not enough turbines to be built for natural gas plants. New natural gas plants, it's going to be difficult to build them within the next 3 years even. And the vast majority of the queue into the grid is solar and battery storage. So if the investment tax credit gets pulled back, long story short, we still are bullish on solar and battery storage. But there is some uncertainty in our marketplace. So we're focused on shorter duration where we're less impacted or we won't be by ITC movements going into next year. But we're also looking to bridge developers that are going to need help.
Just to pick up on your question a little bit more. So we agree with everything that Rich just said, and we've seen quite a bit in solar. We've also seen quite a bit in wind, but keep in mind that one big difference between wind and solar is solar tends to generate at a time when demand is the highest, and wind tends to generate electricity when the demand is the lowest at night. So that's the practical economic implication. And I think I totally agree with Rich. Solar is right now the cheapest source of electricity you could build in the system. That helps a lot. And even setting the subsidies aside. And then the interesting part about the kind of the trade wars and the tariffs that were passed during Biden and now during Trump is that it creates very interesting opportunities for domestic production of the entire solar value chain. So, we commissioned the first solar cell production facility in Georgia, I think it was last year, and solar panels, what have you. So there's for people in the room, one of the things that that's very interesting is that industry, power generation in general, consumes a lot of capital, and solar is going to continue to consume a lot of capital, and a lot of that is domestic jobs, domestic opportunities. So there's multiple ways to play it that goes way beyond owning a solar or a battery facility. You can be a supplier for that. Like one of our facilities that makes solar panels is sold out for the next 10 years. So
Yes, so we buy funds.
It's on you.
Yeah, so we buy portfolios from financial advisors. So typically a financial advisor will come to us and say, I have 10 clients in 10 different funds and they need liquidity across the board. And so the typical deal size is between 3 to 5 million, but the underlying transactions can be as small as 35,000. Just the proliferation of retail alternatives, mostly interval funds, has really drastically reduced the ticket size necessary to get into a fund like BREIT or Starwood, anything like that, the Blackstone credit funds. And so there's really no one playing in that space because the actual ticket sizes, at the end of the day are so small, even though the portfolio itself is of decent size. And so we really can transact across a number of different strategies and structures and dial up the duration or dial it down based on the repurchase programs of the underlying. So there's really just a lot we do structurally to get access to these various asset classes.
So Glenn was asking about creativity in real estate. Are you also touching the real estate space and creative secondaries?
Yeah, absolutely. I'd say that almost all of the big real estate interval funds are oversubscribed on the redemption side. And if you're not as familiar with interval funds, they will repurchase about 5% quarterly of NAV. And then once you're above that limit, everyone gets prorated back. And typically, as soon as that happens, everyone freaks out and starts redeeming. And so that's really happened across the retail or real estate interval funds already. And it's starting in the credit funds as well. So.
Back to you, Ilya.
Let's talk about pricing. What does it look like for your fund? Where's it trending? And how does that ultimately fit into your expected returns?
I'll go. Our loan structures, small dollars, maybe they'll cap out at $10 million. So it's small, and we were formerly on Partners Group platform, and making a 25-30% return on a $5-10 million loan was not even a pat on the back because they need big absolute dollar returns. And so our point was, very high returns in this niche, if you will, on the water is extremely attractive. And so a $50-75 million fund, what we're sizing, can continue to generate those types of returns. Now we're not going to scale to 500 million and start to chase kind of AUM. And the fact is that where we are on the water space, it's niche. There's that's becoming significantly kind of pervasive, but at the same time, there's not very many other folks doing kind of what we're doing, and it's just it's small enough to be kind of less attractive, but it's big enough to generate decent returns. And so pricing wise, we're not really kind of seeing any resistance because of the value, and just it's kind of small absolute dollars. So in the 20% range, and kind of options to get kind of upside returns are all there, but that's kind of what we're pegging at.
we can shift to the side. Pricing, an interesting question because it depends on the underlying asset. We do quite a bit of different assets, but let's just say that, to pick up on the example we shared earlier of our deal, that entrepreneur facing the next stage of their business growth, it typically means they can make an equity return, the incremental expansion of their business, of 30 plus. sometimes even higher. So, we're competing much more with an equity alternative. So kind of the combination of, do you want to have a majority equity owner of this business who will fund that next stage? Plus, as I like to say, like the price of freedom, that party will control you. So, we definitely priced way inside of the equity solution, and ends up being, anywhere between 15 and 20%, I would say, is the all-in pricing. And it really hasn't changed since we've been doing this for the last 15 years. So it's all about finding companies that are successful and want to be even more successful. They want to grow. And as Rich mentioned, if they could borrow from the banks at 6, 7, or even 10%, they would do that anyway. Like we're not trying to compete with that. It's more competing with an equity alternative and the price of freedom. So.
Yeah, I'd say for us, our pricing is between about plus 700 and plus 1,000 above or more. From time to time, we will do warrants. Almost all of our credit opportunities are focused on portfolios of projects. We'll get parental guarantees, but we're really normally not doing holdco loans, corporate loans. It's primarily on hard assets. So solar projects, battery storage projects, or the underlying equipment. Deal sizes are anywhere from call it 3-5 million up to 50.
Yeah, so for us, I'm sort of the other side of the medal. What do you get in return? As I mentioned in the beginning, we see these deals for these, let's say, power to X assets going from mid-teens to high teens on the underlying paper. That let's say bridge financing for 18 months to FID, plus a significant warrant. And again, that's much better than the equity alternative. So in that respect, if you're competing against equity as debt, you're doing something well, because you can get into the low 20s relatively easily with a simple conversation that has to do with control. And folks like much better control with a higher but fair price and clear covenants, and covenants that are sort of like not, I'm gonna interfere with your operations, rather than a number of normal negative covenants. And so the conversation is relatively straightforward. If you compare that to, let's say, the big sort of core infrastructure debt funds like GIP or BlackRock, then you see lower teens, 10 to 12%, AXA. And so they play also in a portion of the market with, let's say, more mature renewables technologies like wind and solar. I'm talking about more, let's say, risk-on technologies for which there is, significant other covenants. Even interestingly, and we talked about this in the beginning and this morning, sponsored projects. Even up to the point where they ask the sponsors to put a guarantee in, because the asset as a collateral is not sufficient enough. So they have to provide a guarantee, which is attractive as a family office if you can sort of put your balance sheet to work without actually paying in. So it provides very high ROI. So those things, that's sort of a typical deals that we see.
So our deals they really depend on what the underlying asset is. It's always priced fundamentally based on where either REITs are trading, BDCs are trading. But a large part of it has to do with the liquidity mechanisms for the underlying fund structures themselves. So for example, on one end, there's funds that don't repurchase at all. They're just going to list on an exchange someday. Those are more aggressively priced against where we're.
What is aggressively priced?
We've done deals at 70% off, but it's more around 50 for something like that, for something that's probably 2 years out from listing on an exchange.
The aggressive pricing dynamics today.
They are getting more aggressive as liquidity dries up, as people.
The default desk is seeing such things. Cookies. Yeah. So you would never do this. It's like the second journey. There it goes.
So this is not what I think, I guess, but we have been seeing a lot more active opportunities come back to us both through NASDAQ private market and through just contacts and connections deals that we do through the proactive and banking side, and also the stress side too. That there's a lot more coming out. Discounts can be just the last round. We don't have seen too many things at 70% off. Nice, but we definitely do get discount the last round. Sometimes it's 15, 20% an average. You see a lot. Depends on who the seller is, sectors, multiples, usual, mantra around everything else. But the way it is, it's definitely a lot of people are looking not just the secondaries, also for liquidity for the companies, and also for a lot of times now, if you realize the time period, we've had situations where it's the employees who need liquidity because their stock options are rolling up. So the 10-year time period is up. They need access, they need out because it's too important for them. So the companies actually have to come to market, even though they get no stock themselves. But we're going to see more and more of the employees come to the market, and a bunch of the VC shops have structured themselves as RIAs to buy smaller positions from those employees too.
Sheer volume. You have to win it, you're back.
Yeah.
Back to you, yeah. We're in the final stage of the.
If I may, and this could be a pretty comprehensive question, but was really curious about the marks of your portfolio. How easy is it for potential LPs to understand those? Has anyone used the word esoteric in reference to how you mark your portfolios?
Hopefully not, right?
Somebody's first to answer.
I can go. So ours, the liquidity events for most of these are exchange listings. And so we are marking them, at a discount to whatever the relevant metric is. So if traded BDCs are trading at a 10% discount to NAV, we'll hold it at least at a 10% discount to NAV plus a margin for illiquidity. And so that is up from our costs, but down from the eventual exit. So that's something that we strike monthly on those products. And it's also nice because when we're reselling those products back at NAV by participating in the repurchase programs, that's well above our marks most of the time.
For us, we have Cohn Resnick. They appraise and value our assets quarterly. They're really one of the largest accounting firms in solar and renewables. So we rely on them on a quarterly basis to mark where we're at.
Everything we do is illiquid, kind of bilaterally sourced. That's kind of the esoteric part, I guess, about it. The kind of good news for us is we do two things. One is almost all of our investments are in a kind of first lien credit form, so it kind of gives you a pretty good perspective if the interest gets paid, which is most of our businesses pay interest, then you can kind of mark the loan position at par because it's servicing the debt, and and we're kind of the only ones in the cap structure. And then we have warrants or equity kickers upside in every deal as well, and those we tend to try to mark as close to zero as our E&Y auditors will let us, because it's only upside from there and we don't control a lot of the monetization. So when we get close to realization, we'll mark them higher, but until then, it's really kind of a true upside share. So that makes it much simpler when LPs look at it. They say, oh, okay, so it's a credit position, interest gets paid, that's how you accrue your return, and then when we exit, you may get paid out in the equity kicker.
Then,
word?
I don't think Denon answered it.
But so not sure yet. He doesn't have anything to mark.
Yeah, I think the only thing that we'd say is our process is one of control of the development process, and 90% of our funds go to the design of the facility. And so if you think about it, designing a facility, that's a percentage where a contractor can go to basically a full contracted price. And so the more you design, the more you know it's going to cost. And so it's kind of feeds that. And so we do it under a stage gated process. So to the extent we've hit a point where some milestones haven't been met, we stop. and it's either delayed or we can basically recoup the dollars spent. And so that's kind of the risk management, but at the same time, it kind of follows the value as we kind of continue to design the project.
David, you're sort of an outlier in a good
Yeah.
way, if you actually do work, not financial.
Well, look, we started out doing development loans and just handing it off and realizing our partners weren't spending it properly.
Solves it, gets you the permits.
Yeah.
And
Yeah.
the money.
Yeah.
But Ilya, we got to move on to the last panel, which is where we make a ton of money. Private equity.
So I guess my last word would be a way for allocators to generate alpha is to do extra bit of homework to understand niche fund such as the ones we just heard, and it's clearly a worthwhile exercise.
And I'll challenge Mark on this. We've had a lot of migration to our funds from people who used to be in private equity. So maybe private equity hasn't made enough money for them.
10 times more in private credit. We agree. But theoretically, the private equity guys are going to tell us about the figure 20.
Theory, practice.
Come join our 361 Firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.